Warren Buffett is famously quoted as saying, "No matter how great the talent or efforts, some things just take time. You can't produce a baby in 1 month by getting 9 women pregnant." This statement has often been embraced by investors as a lesson in patience, suggesting that good results in the market require time and cannot be rushed. The quote has become a guiding principle for many, reinforcing the idea that waiting is an essential part of successful investing. But does patience always lead to better outcomes? In this section, we explore whether patience is truly a virtue in investing, or if it can sometimes become a trap that prevents timely action. By examining the deeper meaning behind Buffett's words, we aim to uncover when patience serves us and when it might hold us back. The quote is often interpreted as a powerful lesson in long-term investing. It highlights the importance of patience, suggesting that true financial growth comes from allowing investments to mature over time. By resisting the urge to react to short-term market fluctuations, investors can avoid impulsive decisions that may undermine their goals. This perspective encourages individuals to focus on steady progress rather than immediate results. Ultimately, the message serves as a reminder that enduring success is built through discipline and a commitment to long-term strategies, rather than chasing quick gains. The popular perspective often emphasizes the act of waiting as the primary strategy for successful investing. However, this approach tends to overlook critical factors such as the quality of the business and the robustness of its underlying processes. Focusing solely on patience can lead to missed opportunities or poor outcomes if the fundamentals are not sound. Business quality, including management effectiveness and competitive advantages, plays a vital role in long-term success. Additionally, a well-defined process helps investors make informed decisions and adapt to changing market conditions. Ignoring these elements can result in suboptimal investments, regardless of how long one waits. Therefore, a comprehensive approach that balances patience with careful evaluation of business fundamentals is essential. Warren Buffett's quote goes beyond simply emphasizing the passage of time. At its core, it highlights the importance of investing in high-quality businesses that can steadily grow and compound value over the years. The true power of compounding lies in choosing companies with durable advantages and strong fundamentals. When time is paired with the right business, growth accelerates exponentially. This approach encourages investors to look beyond short-term gains and focus on the enduring potential of their investments. Ultimately, Buffett's philosophy is about patience and the wisdom of letting great businesses work for you over time. Patience is often celebrated as a virtue in investing, but its effectiveness depends greatly on the quality of the business behind the investment. Waiting for a mediocre company to improve rarely yields significant results, as underlying weaknesses tend to persist or worsen over time. In contrast, patience can be highly rewarding when applied to high-quality businesses with genuine potential for growth. These companies typically possess strong fundamentals, resilient business models, and the capacity to adapt to changing market conditions. By giving such businesses time to execute their strategies and expand, investors increase the likelihood of seeing substantial returns. Ultimately, patience is most powerful when paired with careful selection of investments that demonstrate real promise. Concentration and diversification represent two distinct strategies for allocating resources and effort. Concentration involves focusing on a limited set of goals or areas, allowing for deeper expertise, stronger results, and a greater chance of achieving excellence. In contrast, diversification spreads resources across many pursuits, which can reduce risk but often dilutes impact. When resources, whether time, money, or attention, are divided among too many projects, none receive the focus required to truly excel. This often leads to average or mediocre outcomes, as efforts are insufficient to reach their full potential in any one area. Exceptional results typically arise when energy and resources are concentrated, enabling mastery and significant achievements. A clear investment thesis serves as the foundation for any successful investment strategy. It outlines the rationale behind choosing a particular asset, including its potential for growth and the risks involved. Allowing for a natural gestation period means giving investments the necessary time to mature and realize their full potential, rather than seeking quick returns. This approach closely aligns with Warren Buffett's philosophy, which emphasizes patience, discipline, and a long-term perspective. Buffett advocates for investing in businesses with strong fundamentals and holding them over extended periods, allowing compounding to work its magic. By adhering to a well-defined thesis and respecting the time required for investments to flourish, investors can make more informed decisions and increase their chances of achieving sustainable returns. One of the most common pitfalls investors face is the tendency to hold on to underperforming assets, believing that patience alone will eventually yield positive results. This approach often stems from confusing inaction with prudent long-term strategy. However, not all struggling investments are simply waiting for a turnaround. Some are value traps, securities that appear cheap but have underlying issues that prevent recovery. By neglecting to reassess the fundamentals, investors risk tying up capital in assets that may never rebound. Recognizing the difference between genuine opportunities and persistent underperformers is crucial. Failing to do so can lead to prolonged losses and missed chances elsewhere in the market. The second trap investors often encounter is the illusion of safety created by excessive diversification. While spreading investments across many assets can reduce risk, overdoing it may lead to unintended consequences. With too many holdings, it becomes difficult to monitor each investment effectively, increasing anxiety and uncertainty. Additionally, returns can become diluted as strong performers are offset by weaker ones. This approach may provide a false sense of security, but it can hinder the potential for meaningful growth. Striking a balance between diversification and focus is essential for achieving optimal results. The third common trap investors face is impatience, often leading to speculative behavior. Driven by the desire for rapid gains, some individuals attempt to force quick results, disregarding the underlying fundamentals of the businesses they invest in. This approach can result in chasing trends or reacting impulsively to market movements, rather than making decisions based on careful analysis. By ignoring essential business realities, investors expose themselves to unnecessary risks and potential losses. Recognizing the importance of patience and a disciplined strategy is crucial for long-term success in the market. Active patience is an investment approach that emphasizes thorough research before making decisions. By dedicating time to understand a business's fundamentals, investors can identify companies with strong potential for sustained growth. This method encourages holding on to high-quality businesses for the long term, rather than frequently trading based on short-term market movements. The confidence gained from careful analysis allows investors to remain patient during market fluctuations, trusting in the underlying strength of their chosen investments. Ultimately, active patience combines diligence with restraint, aiming to achieve superior results through thoughtful selection and enduring commitment. True safety in investing is rooted in the quality of the business itself, rather than simply in how long you hold an investment. A well-run company with strong fundamentals, consistent earnings, and a competitive advantage is far more likely to withstand market fluctuations and economic downturns. In contrast, holding shares in a weak or poorly managed business for an extended period does not guarantee protection from loss. This distinction is crucial because it shifts the focus from timing the market to understanding the underlying strength of the investment. By prioritizing business quality, investors can make more informed decisions and reduce the risk associated with their portfolios. Ultimately, long-term success in investing depends on choosing robust businesses, not just on patience or duration. Owning a well-established, steadily growing business offers a unique sense of peace for investors. Rather than being swayed by the daily fluctuations and noise of the broader market, investors can focus on the enduring fundamentals of their company. This approach encourages patience and confidence, knowing that the business is quietly building value over time. The reliability of consistent growth allows for a long-term perspective, reducing the stress often associated with short-term market volatility. Ultimately, this mindset fosters a more stable and rewarding investment experience centered on the gradual maturation of a promising enterprise. When the groundwork for investing is laid out in advance, the entire process becomes remarkably straightforward. By dedicating time to research and planning at the beginning, investors can avoid the anxiety that comes with frequent trading and speculation. Instead of constantly monitoring markets and making rushed decisions, a well-prepared approach allows for calm and steady progress. This method contrasts sharply with the stress and unpredictability of trying to outguess market movements. With the hard work completed up front, investing transforms from a hectic endeavor into a simple, manageable routine. The result is greater peace of mind and a clearer path toward long-term financial goals. As we wrap up, consider how patience and a commitment to quality can shape not only businesses, but also personal growth and investment success. Reflect on the value of allowing ideas and ventures to develop fully before expecting results. We invite you to share your own stories of businesses that have thrived through careful nurturing, or investment quotes that inspire you to think long-term. Your experiences and insights can help build a richer understanding of what it means to truly invest in the future. Together, let's challenge the culture of instant gratification and celebrate the rewards of thoughtful persistence.